Welcome to FuturesOptionsETC.com's online options trading tutorials. You can also visit us on our website www.FuturesOptionsETC.com, or for any special training needs you can contact us at training@FuturesOptionsETC.com for a dedicated trading tutorial session. You can also visit us on our website, that's http://FuturesOptionsETC.com, where you'll find a lot of articles explained with payoff functions, detailed examples and graphs on how to trade options using different option strategies. There's also a search feature available on this website which you can use to search for your desired option strategy and browse through the results. In this set of option trading tutorial, we'll see how to trade a short put option. Short put option trading position is very risky in terms of the offering that it has. It has a very limited profit potential but an unlimited loss potential. In addition to that, you also need a lot of margin money to be kept with your broker because you're taking a big risk. That's why the margin money is required, and that may vary from one broker to the other. So let's take a simple example. Assume that IBM stock is currently trading at $50 per share, and you believe that IBM stock price will rise to around $70 or higher in the next 2 months time. So basically you need to have a bullish view to take a benefit from a short put option position. How can you take advantage of this bullish situation? Choice one is that you simply buy the IBM stock. Now we are not talking about the option here, but the IBM stock, and your buy price is at $50. The other choice is that you short or sell the put option on IBM stock with a strike price of $50, and for this sale you will receive an option premium of $5. Okay. Now assume that your prediction comes true and IBM stock price actually reaches $70. So in case of a stock, your profit would be 70 minus 50, that is $20 per share. In terms of percentage, your profit would be 40% as calculated here. In case of option, what would happen is that since the price has risen in your favor with your bullish view, the option premium will actually reach to $0. We'll see this shortly through the payoff function, but in terms of calculation, what it means is that whatever $5 you received while selling this IBM put option, you get to keep everything because this option premium is now 0, so your profit is $5 per option. In terms of percentage calculations, it comes to 100% because you get to keep all the $5 that you have made from this short put option sale. Now let's see how this particular thing looks when you have to look at it from the payoff functions. A short put option, in this case we're talking about a strike price of $50, and this is how the short put option position would look like. What this means is $50 is the strike price here. Above $50, the payoff function is a zero line, which is at this level. Below $50 means as soon as the IBM stock price, that is the price of the underlying, reaches below $50, then your losses will start to increase, and this is how your losses will keep on increasing. The lower the underlying price goes, the more loss you are going to make. However, this particular payoff function does not account for the option premium or the price of $5 that you have received. So let's introduce that price as well. Since you're shorting this option, that is you're selling this option, and when you sell something you receive that money, so receipt is taken as positive. So this particular maroon or brown color graph will shift upwards by $5, and the simple way to do it is this horizontal line is at 0, you shift it by 5, so this is how it would look. and similarly it goes for the slanting line, again shifting it by $5. So this is how all this short put option trading position would look like. Now what this green color graph tells me is that if my prediction comes true and the IBM stock underlying price is actually going higher than my strike price, that is assuming it reaches 70, then I am going to make this profit of $5. That is the option premium that I received from selling this option, and whether the strike price, the underlying price reaches 70 or 90 or 100, my profit potential will remain limited to $5 only, because that is the maximum amount of money I can make from this short put option trade, and that is what this particular payoff function of green color horizontal line tells me. However, let's have a look at the risk side also. In terms of the risk, let's say your prediction comes wrong, and in case of IBM stock, it goes down to $30. So in case of IBM stock trade, your loss would be $20 per share, or minus 40, that is minus 40%. But in case of IBM put option, what would happen is that your option premium will increase significantly. That is, the amount of money that you will have to pay back to the option buyer, that will increase to $20 or so. So your loss in that case would be $20 minus the $5 that you received upfront while selling this option. So your net loss will be $15. In terms of percentage, it would be 300% loss. So that's where the two stock and option trades are different. In terms of profit, they are, the option provides you a big magnitude of profit. The same thing goes for the loss also. The option still provides you unlimited risk. And let's see that in terms of the payoff function. Here we were talking about the profit areas. This is where my loss area is, because this is below the zero line. So what this means is that as soon as my the underlying price of IBM stock goes below $50, I will become liable to pay back something to the option buyer. So when it reaches 45, that is like the break-even point. I make no profit, no loss, because that is where the green graph is actually crossing the zero line. And further down, if it reaches 40, then I am going to make a net loss of $5. If it reaches 30, then I am going to make a net loss of 15. If it reaches $15, then I am going to make a net loss of 30. And if IBM or the stock in question goes completely bankrupt and it goes to zero, then I am going to make a $45 loss on this particular option trade. Other way to look at it is in terms of the maroon graph, which is without any price. So if this price goes to say $15, then the loss that I'm going to make as calculated for the maroon graph is 35, but we have received $5 from the sale of this option, so the net loss will again come to 30, which is indicated by the green graph. So this is how the option trading for a short put option work. Do note that since you're shorting the option, you will be required to keep a lot of margin money for this kind of situation, because this loss potential is much higher than the limited profit potential that any option trader will have. So that's why the margin money requirement is huge. It is advised that one should start shorting options only after significant experience in options market.